Now in this video we're going to talk about what happens when we sell an asset. So you'll recall that we had an asset that had an original depreciable value of $100,000, a salvage value of $20,000, and had an economic life of 8 years. Now what we're going to assume here is that 5 years have gone by. Somebody's come into your business, they say, I'd like to buy that asset from you. And they say, would you sell it to me for $70,000? And you say, sold. It's yours, I'll help you carry it out to the truck. But at any rate, you selling your asset. And what happens with that? What's the tax consequences of doing that? Well, a couple of things to note here. We're going to sell the asset for $70,000. Now remember, there's two kinds of gains. There's a capital gain, and then there's depreciation recapture. To have a capital gain now, we would have had to sold the asset for more than the original depreciable value, which was $100,000. So is there a capital gain in this case? The answer is no, because we didn't sell the asset for more than $100,000. So there is no capital gain. The other thing you would want to know in order to calculate any tax consequences is, what's the marginal tax on our income? And that is, if I bring in this income, what's the tax rate associated with that additional income that I'm bringing into the company? And we're going to assume, for our example, that the tax rate is 30%. How do you calculate depreciation recapture? When there's no capital gains involved in it. You take the sell price of the asset, $70,000 in this case, you subtract from it the book value of the asset at that point in time. So 5 years have gone by, and we're selling this asset with an original depreciable value of $100,000. We're selling it for $70,000. And at that point in time, the book value of the asset is $50,000. This is what you're telling the IRS this asset's really worth now. You've depreciated it down to that point. That's going to be a little bit of a contention with the IRS here in just a minute, but that's what you've told the IRS. So if you take the sell price of the asset, $70,000, subtract the book value of the asset, which is $50,000, you get depreciation recapture, which is $20,000. And it's at that point that the IRS is going to come in and say, you told me this asset was worth $50,000. Turns out it was really worth $70,000. You depreciated this asset too much. How much too much? Well, $20,000 too much. And you've avoided paying taxes on that. That's what depreciation expense is. So you've avoided paying taxes somehow or another on $20,000. The IRS will now make you declare that income. Depreciation recapture is what it's called. And they'll make you pay for the taxes on that income at your highest marginal rate at the moment, which we're saying is 30%. So here's depreciation recapture at $20,000. Our marginal tax rate is 30%. 20,000 times 0.30 gives you the taxes that you would owe if you sold the asset, which is you owe the IRS $6,000 from the sale of that asset. And again, this is called depreciation recapture. It occurs when you sell an asset for more than book value, but less than the original depreciable value of the asset. The thing to remember is depreciation recapture now, whatever that is, it's going to be taxed as ordinary corporate income. That's going to be the highest rate that they can tax you. And in this case, you owe $6,000.